You've probably heard it a million times, just put all your money into index funds. Even investing legends like Warren Buffett recommend it. Frankly, they're not wrong. Most active managers fail to outperform simple, low-cost index fund after fees, and I invest the majority of my own money and client money into index funds. But what if there was a smarter way that you could potentially beat index funds? What if you could invest scientifically in specific factors or styles that have outperformed index funds over statistically significant periods of time? In this video, we're going to look at how an index fund is constructed, the potential problems of index funds, how these alternative factor investment styles work, and why, if you do just beat the market by just 1% a year, this can add huge amounts of wealth over time. So why even try and beat the market? Why not just use index funds and be done with it? To highlight how important just a 1% increase in returns can be to your portfolio, let's start with Tom, an index investor. So he's 25 years old, he's just entered the workforce. Between him and his employer, he's contributing $4,000 a year into his pension. We assume he continues contributing this amount until age 60, and his contribution rises by 2.5% a year as he hopefully gets inflationary pay rises. His investments, they grow by 7% annually. By the time he reaches age 60, his pension will be worth £772,504. Not bad. But what if Tom was able to eke out just an extra 1% return annually? And we'll use the same assumptions. In this case, his pension would grow to over £950,000 by age 60, which is more than an additional £187,000, which shows the true power of compound interest. If he could generate an extra 2% return, he'd end up with 1.2 million quid by age 60. That's great for Tom, who has time on his side, but my YouTube analytics tell me that most of my audience are male and a bit more mature, shall we say. What implications would a high return have for someone already in drawdown? So if you were in drawdown and you were able to generate a high return in your pension fund, the benefit of this is that the growth would support the longevity and sustainability of the fund, and you may be able to take a higher comparable amount of income. It could lead to a higher remaining fund at your date of death, which is really, really important when you think how pensions under current legislation at the time of this recording are usually exempt from inheritance tax, which could mean a nice legacy for your loved ones after you've gone. Before we start looking at some of the issues with index funds, we need to understand how they're constructed and how a company makes its way into a stock market index. With a market cap weighted index such as the S&P 500 or the UK's version of the FTSE 100, the market cap of a company is calculated by taking the share price and you multiply it by the number of shares. The larger a company's market cap, the greater the weighting it will have in an index. This is why it's a really powerful investment strategy. It guarantees that you catch the biggest winners. This is important because, according to research in 2019, just 4% of US stocks accounted for all of the returns of the US stock market from 1926 to 2016. Indexing ensures that on at least some level you're going to capture some of these companies, and it also makes you think twice about thinking you've got the skill to pick those 4% of those individual companies. I know I am pretty humble enough to say that I probably can't. That brings me to the problem of market cap weighted index funds. So we know the good things about them, what are the bad? So as a company's market cap gets larger and larger, so does its position in the index. This is why the top 10 stocks in the S&P 500, largely driven by the Magnificent Seven, account for nearly a third of the index. If these mega cap tech and AI companies, which are richly valued, and I've looked at high valuations in other videos, if they fail to live up to expectations, this could spell trouble for index funds. If we go back in time, we can see that the concentration within the S&P 500 has now surpassed that of the dot-com crash at the turn of the millennium, when the top 10 largest stocks accounted for a similar amount. It was 27% in that case, according to research carried out by Goldman Sachs. But I invest internationally, you may be asking, or I invest using a multi-asset fund. I'm more diversified than just the US stock market, you might be saying. Well, not quite. Let's look at the MSCI World Index, an example which many index funds and multi-asset funds are based off. The US equity market makes up around 71% of the index, so the performance of a global equity index fund is intertwined with that of the US stock market. Okay, so we now know some of the pitfalls of market cap weighted indices, but is there a better way to make an index? One alternative approach is considering an equal weighted index. Take the S&P 500 as an example. This would involve giving an equal weighting to all 500 companies within the index, resulting in a position size of 0.2% for each individual company. Using the Magnificent Seven as an example, rather than making up nearly a third of the S&P market cap weighted index, they would have a collective position size of just 1.4% in an equal weighted version. So how does the performance of an equal weighted index of the S&P 500 stack up against the traditional market cap weighted index? Had you invested in the S&P 500 in 1990, you would have grown your money by around 11.37% a year. How about if you'd invested in an equal weighted version of this index? You would have grown your money by approximately 12% a year. Although this additional 0.63% return a year sounds pretty trivial, due to the power of compound interest, your fund value would be higher by around a quarter. However, to the best of my knowledge, it's got to be said, the oldest equal weighted ETF was not introduced until 2003, so investing in a fund or ETF may not have been possible back then. If we know an equal weighted index has outperformed over the longer term, why not just invest all your money in an equal weighted index? Well, one issue with that is that you really want to invest in something that you can stick to and won't deviate from and jump from strategy to strategy. There's no guarantee that the outperformance of an equal weighted index will continue indefinitely. Let's take the past 10 years as an example. The market cap weighted index has actually significantly outperformed the equal weighted version. It's unlikely that most people would be able to tolerate such underperformance and would likely throw in the towel, potentially at the worst possible time, just before the fortunes reversed. Using the S&P 500 as an example again, another downside of an equal weighted index is that the fund charges are higher. As a UK investor, you can access the S&P 500 market cap weighted ETF for around 7 basis points. Bit of jargon for you there. The equal weighted version, on the other hand, is around 3 times that, which, while still very, very cheap overall compared to active funds, it is a little bit more expensive than the traditional index fund. Something else to consider is investing in factors that have outperformed the market over statistically significant periods of time. You may have heard this ostentatiously referred to as smart beta. I like to think of factor investing as a hybrid really between passive and active investing. I think of it as passive in the sense it's based on mechanical rules and is quantitative in that factor investing tries to identify and invest in companies that exhibit certain characteristics, and the selection is often computer driven. It takes human emotion out of the stock selection process. One of these factors, it's called momentum. This involves looking back at a particular time frame, with 12 months being a very popular choice, and investing in the stocks that have gone up the most during this 12-month period. The idea is that investments that have risen, they'll continue to do so. Academic research shows strong support for the momentum factor across various asset classes and geographies. In Larry Swedrow's excellent book, he found that the momentum factor, he had the premium for this for the US stock markets at around 9% a year. So that's an additional 9% on top of the standard index return. But what are the criticisms? The first is that much of this empirical research is based on going long the stocks with the most momentum and going short on the stocks with the worst momentum. If you invest in momentum via a typical long-only fund or ETF that tries to replicate this factor or target it, typically it's only going to be long-only. However, in a 2014 research paper, they found that 52% of the US momentum premium for stocks came from the long-only side, which is pretty decent when you consider that the 9% premium Swedrow claims in his book. So let's compare the MSCI World Index, which is an index made up of 23 developed countries. We'll compare the standard market cap weighted index, which many global equity index funds try and replicate. And we're going to compare this to the MSCI World Momentum Index. The data goes back to 1975, which is a decent sample size. During this period, the standard market cap weighted version rose by a very respectable 11.47% per year. How about the momentum version over the same period? Well, over this time frame, A lump sum investment would be triple that of the market weighted index with a whopping annualised return of 14.52% per year. That sounds great, I fancy some of that, but what are the downsides of this strategy? The first is that momentum investing doesn't work all the time. When the market crashes, the falls with momentum investing can be spectacular and is more volatile. As is often the case with investing, especially factor investing, the volatility and the periods of underperformance can cause you to jump ship and abandon the strategy at the exact absolute worst wrong time. Another criticism is that nobody is exactly sure why momentum works. One argument is that it relates to investors' behaviour, the idea that investors underreact to new information and are slow to adjust. For example, let's say improving fundamentals, or that investors sell when a stock goes up despite those improving fundamentals. Perhaps its profits are up or what have you. Another reason to be cautious if this outperformance will continue is that this type of investing is now pretty widely known, with more money focused on this strategy and invested in along these lines, potentially leading to this premium being arbitraged away. Value investing. This is another popular investment strategy focused on purchasing stocks that appear to be undervalued by the market. Pioneers of this are the likes of Benjamin Graham and Warren Buffett, who we mentioned earlier. The philosophy of this, it seeks to identify companies whose stock's price do not reflect their intrinsic value. The key to value investing lies in assessing that intrinsic value, which is typically estimated through a company's fundamentals. This includes analysing the financial statements such as earnings, revenue, dividends, and cash flow. Investors also consider ratios like the price to earnings and dividend yield of a stock. Like the momentum factor earlier, there's substantial evidence which supports value investing. According to Larry Swedroe, he estimates that the value factor has a premium of around 4.8% for US stocks between 1927 and 2015. As we did with the momentum factor, let's compare the performance of the market cap weighted MSCI World Index against the equivalent value index, which also goes back to 1974. As we know, the standard market cap weighted version rose by approximately 11.47% a year. Meanwhile, the value weighted version has risen by 12.25% per year. Okay, it's not quite as impressive as the momentum factor over the same period, but as we know, just a small incremental increase in returns can make a huge difference. So, why not invest all your money into a value factor fund or shares? Firstly, value investing, it's prone to periods of significant underperformance. Take the past 10 years or so, during which value has experienced one of its worst periods, underperforming both growth and glamour stocks and the market cap weighted indices such as the S&P 500. It's unlikely that many investors could stomach such ghastly performance and would simply lack the fortitude to hold their noses and hope brighter days. Another argument against concentrating solely on value stocks is that they tend to be more traditional companies, such as bricks and mortar businesses, banks, oil and gas and manufacturing, etc. In today's era of high-tech, software and intangible assets, the rules of the game may have changed. And like with the momentum factor, an influx of money into these strategies may mean that value investing might not work anymore. If you are considering factor investing or allocating some of your money away from market cap weighted indices, I wouldn't suggest throwing all your money into a particular factor strategy. It's always a good idea to invest in several of them, be it value, momentum, smaller companies or companies with high quality characteristics. The latter of the two I haven't discussed in this video just for the sake of brevity, as historically these factors have all worked at different times. For example, value often works well when momentum isn't. I think the success in harvesting these potential additional premiums come down to the ability to really stay the course over the long term and not throw in the towel when the inevitable slow periods or underwhelming periods happen. I'm not saying index funds are crap either by any way. As I say, I've got the bulk of my own money and client money in index funds. But if you are considering a bit of juice to your portfolio, it is something to consider. But of course, there's no guarantee that these factors will continue to work in the future, which is why I'd be wary of investing all or even a large proportion of your money into such strategies. If you are concerned about stock market crash affecting your retirement, take a look at this video, which explores what you can do to minimise the risk of this affecting your retirement.